Before you say yes to that dream home in California, there's something nobody tells you about. And I'm not talking about your down payment. I'm talking about the 8 hidden fees that are about to drain your bank account the day you close. And we're talking thousands, sometimes tens of thousands, that if you're not informed, just disappear. And here's the kicker. Most buyers don't even know these costs exist until it's too late. But not you, not today. Breaking down exactly what these 8 closing costs are, how much they'll cost you, and most importantly, how to dodge them or negotiate them down. So if you're ready, let's go. Let's start with the reality. You just got approved for your mortgage. You're super excited. You found the dream home. And then your lender sends you a closing disclosure form. It's pages long, numbers are everywhere, and somewhere in there, a line item that says total closing costs. For most California buyers right now, you're looking at 2% to 5% of your loan amount. Let me put that in perspective. If you're buying a $600,000 home with 20% down, that's $480,000 loan. 2% to 5% means you're paying somewhere between $9,600 and $24,000 just in closing costs. Not your down payment, not your new furniture, just closing costs. But here's what kills most buyers. Nobody budgets for this. You've been saving for the down payment, right? You've calculated every dollar, but then closing costs hit and suddenly you're short. You're stressed. You're either scrambling to find extra cash or you're asking the seller to cover it, which sometimes can tank your offer. So let's break down these 8 major closing costs that are basically non-negotiable. These are the ones that add up fast. All right, first up, and this is a big one, loan origination fees, sometimes called discount points. Your lender basically charges you a fee for underwriting, processing, and approving your loan. Here's the breakdown. This fee is typically 0.5% to 1% of your total loan amount. So on that $480,000 loan, you're looking at $2,400 to $4,800 just for the privilege of borrowing money from them. Now, here's where it gets tricky. You have options. Option 1, pay the origination fee up front. That's the $2,400 to $4,800 and get a standard interest rate. Option number 2, you can roll that fee into your loan and pay interest on it for 30 years. Sounds good, right? Wrong. You just ended up paying way more than you needed to. Or, and this is the third option, some buyers pay discount points to buy down their interest rate. So instead of a 7% rate, you might get 6.75, but you pay 1% of the loan, $4,800 upfront to get there. Here's your solution. Shop lenders. Seriously. Not all lenders are created equally, and not all lenders charge the same origination fees. Some credit unions charge 0.5%, others charge 1.5%. That's a difference of $4,800 on a $480,000 loan. Don't just take the first offer. Get 3 quotes. Cost number 2 might sound small, but it's a trap. The appraisal fee. Your lender requires a licensed appraiser to confirm that the house is actually worth what you're paying for it. Seems fair, right? But here's the problem. This fee is anywhere from $500 to $1,000, and you pay it up front before you close, before you even know if the appraisal even comes in at the value that you're paying for the home. Here's your nightmare scenario. You pay $800 for the appraisal. The appraiser comes back and says, this house is only worth $550,000, not $600,000. Now what? Your deal's underwater. The lender won't lend on it. You either have to renegotiate with the seller, walk away, or you're going to cover the difference yourself. And that $800 appraisal fee, that's gone. You've already paid that. So here's your solution. Ask your real estate agent to pull comparable sales before you make an offer. Make sure the offer is in line with the market value. This reduces the risk of a low appraisal, and also some lenders will credit back your appraisal fee if you refinance with them within 6 months. Just ask about it. Cost number 3, escrow fees and closing fees. This is paid to the title company or escrow agent who basically manages the entire transaction. They hold your earnest money deposit, prepare all the documents, coordinate with the lender, verify the title is clear, and manage the final closing. And it's a lot of work. In California, this is typically a shared cost between buyer and seller. But here's the thing. It's usually substantial. We're talking $1,000 to $3,000 depending on the price of the home. Your portion might be half of that, but even $500 to $1,500 is real money. Here's your solution. This fee is pretty fixed. You're not going to get out of it, but in your purchase agreement, negotiate who pays for what. Sometimes sellers will cover more of these costs as part of the negotiations. Also, get the free estimate in writing from the title company before you're locked in. You can also shop title companies because prices do vary. Cost number 4, and this is something most people don't think about until closing day: lender's title insurance. Here's the deal. The title company does a search to make sure the seller actually owns the property and there are no liens or claims against it. But what if they miss something? What if there's a hidden lien from 1987 that pops up and someone claims ownership? Your lender could lose their money, so they require you to buy title insurance to protect them. This is a one-time premium, and it's typically $500 to $1,500, depending on the loan amount. If you pay at closing and you're done, it's not annual, it's a one shot. But here's the kicker. There's also owner's title insurance. That's different from lender's title insurance. That protects you. Most lenders will credit you if you buy owner's title insurance at the same time. So that's a smart move to make. Here's a solution. You can't avoid lender's title insurance. It's mandatory, but you can get quotes from different title companies because, again, prices vary. And absolutely, buy owner's title insurance at the same time. It's cheaper when it's bundled together and it protects your equity. All right, cost number 5, prepaid interest. Now we're getting to the hidden closing costs, the ones that surprise people because they look at a bill and go, wait, I'm paying interest on a loan I literally just got? Here's how mortgages work. You pay interest in arrears, meaning the interest you pay in January covers the loan balance from December. But when you close on your home mid-month, the interest accrues from the day of closing until the end of the month. And guess what? You have to prepay it. So if you're closing on January 15th, you're prepaying the interest from January 15th through January 31st. That might be $200 or it might be $800, depending on your loan amount and the interest rate. Here's your solution. This is almost impossible to avoid, but here's the hack: time you're closing strategically. If you close on the last day of the month, you owe less prepaid interest. Not a game changer, but every dollar counts, as you know. Also, factor this into your closing cost estimate. Don't be shocked by it. Cost number 6, prorated property taxes. Cost number 6 is huge, and most people don't understand it. Prorated property taxes and escrow reserves. Here's your situation. Property taxes are due on your home. The county bills you. If you miss a payment, the lender can foreclose. So lenders aren't taking that risk. At closing, your lender is going to require you to deposit money into an escrow account, basically a reserve fund, and this fund will hold enough money to cover your first few months or sometimes the entire first year of property taxes and homeowners insurance. And here's the real numbers. In California, property taxes are about 1.1% of the home assessed value per year. On a $600,000 home, that's roughly $6,600 per year or $550 per month. Your lender might require you to deposit 2 to 3 months up front. That's $1,100 to $1,650 at closing, just sitting in an escrow account. Plus, if there's a gap between closing and the next tax bill date, you might owe prorated taxes, meaning the seller's portion of property taxes that are now your responsibility. That's hundreds of more dollars. So here's your solution. Ask your lender for an escrow statement showing exactly how much they're requiring. Sometimes you can negotiate this down. Also, some lenders have lower escrow requirements than others. Get quotes from multiple lenders because this could save you thousands. Cost number 7, homeowners insurance premium. Your lender requires proof of homeowners insurance before they'll fund the loan. And not just proof, they want the full first year paid upfront at closing. In California, homeowners insurance varies by location and the home, but you're looking at $1,000 to $2,500 per year, depending on the property and your coverage. Your lender is going to require you to pay this in full before closing. So we're talking anywhere from, again, $1,000 to $2,500 that you need to have ready to close. Your solution? Shop for insurance now while you're still in escrow. Don't wait until closing day. Different insurers have different rates. And also ask about discounts by bundling with your auto insurance, boating insurance, installing security systems, etc. You could save 10 to 20% and free up cash at closing. Also, your real estate agent should help coordinate this timeline. We can make sure quotes are back in time. Cost number 8, private mortgage insurance, and that's PMI upfront. Cost number 8, and this one is brutal, if it applies to you. The private mortgage insurance PMI upfront premium. Here's your scenario. You're putting down 15% instead of 20%. Your lender is taking on more risk, so they require PMI, private mortgage insurance, that protects them if you default. Fair enough, but here's what kills buyers. Some lenders require an upfront PMI premium at closing, in addition to monthly PMI payments, and we're talking 1% to 2% of the loan amount. On a $480,000 loan, that's $4,800 to $9,600 paid at closing. Plus, you're also paying monthly PMI premiums for the next 10 plus years until you hit the 20% equity mark. Your solution? Ask your lender up front if they require an upfront PMI premium. Some do, some don't. If they do, shop other lenders. Many don't require it. Also consider putting down 20% if you can. I know it's easier said than done, but you'll avoid PMI entirely. Or put 15% down and plan to refinance once you hit the 20% equity. Okay, let's do the math. You're buying a $600,000 home, 20% down equals you have a $480,000 loan. Your loan origination was $2,400 to $4,800. Your appraisal, let's call it $800. Escrow and closing, $1,500. Lender's title insurance, let's say $800. Prepaid interest, $400. Again, an estimate. Prorated property taxes, $1,200. Homeowner's insurance, year one, $1,500. PMI, 0 because you put down 20%. But your total there is between $8,600 to $11,000. But wait, if you only put that 15% down, add another $7,200 to $14,400 for the PMI. You're looking at $15,800 to $25,400 in closing costs on a $600,000 home. That's not including your down payment. Now here's what I tell my buyers, and this is crucial. These costs are not all set in stone. So shop lenders. Don't use a lender your agent recommends necessarily or your cousin. Get quotes from at least 3 different lenders, banks, credit unions, and mortgage brokers. And then let them show you the origination fees, title costs, title insurance costs, escrow requirements, and PMI policy applicable. The differences will shock you. One lender might charge 1% origination fees, another 0.5%. That's thousands of dollars in difference. And get everything in writing to compare apples to apples. In your purchase agreement, you can ask the seller to cover certain closing costs. Instead of asking for a lower price, ask them to cover the appraisal fee, title insurance, escrow fees, or split it differently. In today's market, sellers are more motivated, and you might be surprised what they'll cover. But you have to ask. And your agent, again, should be pushing for this. Don't just budget for your down payment. Include a 3 to 5% more for closing costs. If you're buying a $600,000 home with $120,000 down, also have about $18,000 to $30,000 for closing costs. Yeah, that is a lot. But that way you won't be stressed at closing and you won't be scrambling. All right, just to review, if you're buying a home in California and you don't have a real estate agent helping you navigate these costs, you're leaving money on the table, literally thousands. So remember, shop lenders and negotiate origination fees. Navigate escrow and title requirements. Anticipate local costs specific to your neighborhood. Negotiate seller concessions to cover closing costs. Stay organized and stress-free from offer to closing. Hey, I hope this video helped you. Drop a comment. Tell me what surprised you most about your closing costs. What questions do you still have? Thanks for watching, and stay blessed.